Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through the market update. I rolled out the new earnings plan for Q3, so that's all been pushed to your profiles. If you didn't get it, you should get an email notification. If you didn't get it, just let me know in the chat, and I'll make sure that you're on the list. You all should be on there. And we'll go through the results of Q2, and then Joe will finish up. So let's get started. Okay, markets overall, same as last week. Nasdaq, SPX in one, Russell still in two. A little bit of change in the sectors. The financials went in, the state one. Green pie wise, fairly flat. We dropped a little, 37 down to 32. So, we're still not, 30 is our oversold indicator. So, we're on the cusp of that. So, let's take a look at the charts here. You can see, we had that turnaround. And it's just kind of gone sideways here. So, you can see back here, we do have a bunch of these. Once it turns pretty hard, that's when we get those crosses. So just kind of floating along here. Let's look at the individual states. Nothing really with the highs and lows, just kind of bouncing around. Nothing significant though. You can see here, nothing, hundreds, nothing big. So I think the market is trying to figure out where it's going. And, we'll go to the charts, but we're on some very specific support levels. So we'll get into that in a minute here. Overall, at this current states, 8 has been climbing just slightly, but just kind of like a confused market right now, trying to figure out which way it wants to go. Nothing really jumps out, as far as here, other than we're getting close to that 30% for the green pie. So that's typically where things like to start turning around. So all right, let's look at SPX. So obviously not an ideal state one so far. Typically, we'll go up here, kind of retest, get up here, and then 30% will go higher, and the other 70 will go down lower. So what we're really looking at here would be, this entry price is going to be the near-term resistance level, and then our stop losses are the support level. So, the supports are 44, right around 4,400, 4,500, just to kind of make them round numbers. And then, so if we get above that, obviously, we could, make them run up to these target one areas. So that's pretty decent run, 150 points or so. But that would entail making a new high too. So let's look at those charts. So more importantly, the 50-day, we're on it. So you can see it tested here on the 7th, and we bounced back up. This all started here. We kind of crossed below, and then we had a big day up, and then tested it here, and we're at 4442. So that's below, in between the stops and entry. So this is what I'd be watching as far as SPX, that if that gets tested again. If it holds support, then obviously the rows are pointing higher short term. So let's look at the overall range. So the recent high is 4607. that's well below our targets here. So, we get first step, we'd have to get above this entry and then, try and make a new high. Uh, but, you know, that hasn't been that strong. That's the top of our level is at 46. The bottom is the 42. So I haven't really gotten close to that. But really, it's just kind of watching that 50 days, staying above that. Obviously, that's going to be bullish. And then, um, the next level up is at 4,600, getting above that and, closing above that and holding. So that's where we're at with SPX. Russell's a little more, the chart's really good. Okay, so it's just kind of been back and forth here between, kind of the levels for state modeling. So, that's going to be resistance. That's going to be support, going higher. So right now we're below the entry. So that's your near term resistance. And then, here is further along resistance. So, and your support's down here overall. So this one's in two, the other ones are in one. So it's been in there, 19 trading days and it only averages 8. So market's just trying to figure out what's going on. So let's look at the chart. So I do like when these things line up pretty much. So the SPX is right near that 50 day EMA, and then the Russell's pretty much right on that 200, which you can see here. Let me annotate. Test, 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 test. So obviously very critical support level there that we need to hold to get bullish overall. So, and I think, that's at 1845, and we've just been kind of playing with that level all day. So it's 1848, but, it's holding throughout the day. So just, keep an eye on that. If that breaks, it's hard to say, that could get ugly, if that 200-day breaks, but you would, for it to get ugly, we'd have to break the 50 and the 200. And I would expect like rates to, spike up. So the rates have been kind of hovering around this level, 429. We did have a drop and then it just popped right back up. So those have been staying elevated overall. And yeah, so as far as the levels, we have that 1900 critical, that's going to be resistance, if we do spike up, and then, the bottom 17. So that's our trading range that we've been in. Though, we talked a lot about, the previous occurrences where we jumped above that 19, and I'll just throw this in there real quick. So this is the third time, all lower highs, lower, lower, lower high. So every other one, went down and found the bottom of that range. So it's just something to be careful. If we do break that 200, I could see it, dropping down to that 17. But if we hold and, get above 19, this could be the end of these, 3 pillars here. So that's where we're at as far as the markets. I'll do a quick Fed. So, we're a week out from the meeting and pretty much nothing priced in, no rate hike priced in. And further out, they still kind of one priced in somewhat, not guaranteed, but somewhat priced in. So it's kind of like flip-flop. And then, longer term, they're seeing cuts by the end of next year, quite significant cuts. So not much change from last week on that. And we did get some inflation numbers. I'm not sure if Joe talked about this, but the core, month over month, a little hotter, but these ones, the inflation, which I think this one has like gas and stuff, it was the previous month 0.2, so we had a big jump, 0.6, and market really hasn't reacted too much to it. So, we have more data coming out for inflation tomorrow too. So I think that's it for market update. I'll open up to questions, comments.
Hey, Josh, it's Lee.
Hey, Lee.
Hey, what do you think about the 10-year bonds now? I think it's 4.2 something.
Mm-hmm.
What are your
425.
thoughts? Pardon?
425.
Okay.
Yeah. Well, I mean, once the Fed shifts, that could be, like the way you trade those, like with the ETF is TLT. That's a long term. It's up, on our dashboard. TLT here, it's been an 8 getting killed. But, once the market, the Fed's like, okay, we're going to start cutting, that's when TLT will return well. So I'm not sure what it's yielding currently. I can pull it up. But once the pivot happens, and who knows when that is, I would just wait until it's abundantly clear and the Fed's like, yeah, we're gonna start cutting. At that point, you can get in something like this where it's yielding 3.22, and you'll get some appreciation too if they do start cutting rates and stuff like that. So that's what I think there. I'm not sure if it's going to go higher or not. These inflation, you know, this with to see how the inflation goes. So, obviously it was a little hotter than the last month, and I don't know, if we're at the end of this or not. So it's hard to
Right,
say.
right. All right.
Good, Josh.
Thank you.
Yeah, surely. Dave?
Josh, can you hear me okay? I'm
Yeah,
not sure. I
gotcha.
have new hardware I'm operating with, and last time I couldn't even talk, so I didn't. I was to the point that Lee just made. I was reading an article just today where some Fed researchers were finding some large trades by entities that have access to the repo window, where
Mhm.
they're selling a futures contract today and buying the same underlying treasuries that they're going to have to deliver for that contract, and using the Fed repro window to fund it.
Hmm.
And from I don't trade futures, but from what I know about options, is when you're selling a future or an option, you're taking on an obligation to potentially have to deliver or sell at the strike price you choose.
Mhm.
And if let's say the Fed does have to raise rates again, that would put pressure on the existing underlying securities or contracts that you already own or are obligated to, and that's only going to get worse if volatility increases, which would likely happen if interest rates get raised again. So
Mhm.
to me, that sounds like, I don't know why the Fed is even enabling that situation to happen. And I think that's why they wrote the article saying, whoa, wait a minute, some people are taking extra risk on because they're allowed to, or because they can. So and today, what do we see? We saw the core and the non-core and CPI rate go up.
Right.
So the Fed takes its foot off the gas and prices rise. So
Right.
does that sound like the Fed's going to keep quiet if prices don't go down? It's like
Mhm.
I would almost rather have the Fed raise prices this time than in November, but raise rates this time, but rather than November. But that's just me. I'd rather get the pain out over with earlier than wait till closer to the end of the year. And I don't know what other people think about that, but that's just my own personal opinion. I'd rather work with data that I know, and okay, we've hit the bottom. I'd rather have had a capitulation sell-off before now than having avoided one to be skittish on wherever the future is heading. It's headed for us. That's anyway. I don't know whether that's an issue to be worried about. The Fed, the leveraged treasuries, trade. It just doesn't sound like a good idea to me, though. All right, I'll stop there. But it'd be interesting if anybody else had any comments. I'd be curious to hear them. If not, no, that's okay.
Yeah, I didn't see the article, but I mean, there are sometimes people just treat it as a casino, so I don't know the specifics of the trades and stuff, but if I would say in general, if rates go up, you have to watch out for the bank balance sheets and stuff like that, which we already saw, back with like Silicon Valley Bank and stuff. So, but right now they're pricing in cuts at the end of by the end of next year. So, we've seen this before, where they mispriced it. Mm, I don't, people don't know, but, they have to start somewhere, right? There has to be an expectation for somewhere. So, I don't know, and if they raise rates, that doesn't necessarily mean the 10-year is going up, So just a lot of different moving parts. And the key thing is the 10-year, not so much, I mean, obviously the Fed has a lot of, it affects all the rates and stuff like that. But, the 10-year kind of does its own thing a lot. So, if we keep raising that, it's hard to say how much, 10-year will go up. If we see it like really go up, that's going to be a big problem.
I think it has to go up, doesn't it?
What's that?
Well, it eventually has to go up because the yield curve has to uninvert.
Yeah.
Right? For the yield curve to uninvert, and that would be the definition of a soft landing, is that the yield curve uninverts and there's no negative GDP quarters. Right? That would be unique in history, that we don't have a recession with inverted yield curve, but that would be the definition of a soft landing. And in order for it to uninvert, either the low end has to go down or the high end,
short term.
Yeah, the short term has to go down and the long term has to go up. And the short term yield is not going to go down with the Fed at, with the Fed funds 5 plus. Because, if an investor can get 5% CDs, you can get 5% CDs for 6 months. Why are you going to commit to 10 years?
Right.
So in my opinion, the more likely thing is that the 10-year yield goes up. And that's how the yield curve has to uninvert sometime. And when it goes up, you've shown many charts, it goes above 4.5, that's back to stop. Right?
Yeah. Yeah.
And I think it has to go up. I don't know why or how, but in order for the thing to uninvert, it has to go up.
Yeah, I mean, if they keep the rates up, yeah. I mean, so let's just looking at the forecasting, and like these are saying, a year out we're going to be 1% lower on the Fed funds rate, right? So that move all these down to like 4.25, so that would be below, or equal to that 10-year. So that's just, I think, the soft landing type thing people are, still hoping for, right? So
that's what they're hoping for, but I just don't see the Fed until they hit their goal dropping the rate. That's the only way that the short end will uninvert the curve. If the Fed drops the rate. And they've given no indication that they're going to do that, even though the futures market seems to think so.
Yeah, the only thing we know is they're not going to cut rates this year, right? So beyond
Right.
that, the next year is kind of a up in the air, but people are already pricing it in, so yeah, I mean, if they keep them up, yeah, the yields will come up eventually, and I think, you got like recession risk, which keeps things low on the long term, right? So
I'll tell you the big one I don't think anybody's talking about is I think we're going to have a government shutdown in a month.
yeah,
I don't think the clowns in Congress can agree. I think just like in 2011 they shut the government, I think they're going to shut it down. And
Hey,
I don't agree with you, Sudhir.
yeah.
yeah, but Sudhir, what do you think the effect on the market will be if there is a shutdown?
you know, it's happened before. We'd have to look back at 2011 was the last big shutdown. And I don't remember back then what happened to the market, but it can't be good to have large portions of the government, which, pays people money, wages and stuff, which then goes into the economy. Can't be good for having large portions of the government shut down for
Hmm.
5, 6 weeks. I mean, it's just like if a big factory shut down, then people don't get paid and that money doesn't get spent in restaurants and travel and stuff like that. So I can't imagine it being good for the stock market.
Yeah, and the longer it goes, the worse, it is, the more effect. Yeah, that's good. Good points, good questions. Yeah, I'm not sure. Yeah, I don't, I'm not sure what's going to go on with the funding. So as we get closer, we'll hear more stuff, I think. So, okay. Thanks to the early. Anyone else before we jump into our earnings?
Yeah, Josh, Dan here. A couple
Yeah, hey,
comments.
Dan.
Yeah, I agree with Dave. I'd rather see the pain now rather than later on. But I think some of the problems that the Fed is faced with is, if they, I think they're caught between a rock and a hard place, and that, for them to, I think the elephant in the room really is our national debt, $32 trillion.
Yeah.
And just the interest that we pay yearly on that is greater than our GDP. And it's going to go up even more next year and year after that. And if they do quantitative easing, which is basically saying we don't have enough money to pay our bills, so we're going to just print up more money, which will devalue the dollar. And that will just increase inflation overall, So I think they're going to be stuck, increasing the rates,
Mhm.
and but I think the biggest problem is that the national debt that we're faced with, and we're talking about the government shutdown. Like any business, not that the government is a real business, but I think you're going to be looking at cutting a lot of things. I think at least the Republicans are. Democrats, I think they're going to continue to try to kick the can down the road, but I think we've kicked it down about as far as you can go. So I don't know. It looks pretty precarious going forward to me.
Well, it's not going down, it's just accelerating. The higher rates is going to go faster and faster, right? We're almost at 33 trillion.
Yeah.
So, that's
Yeah.
100,000 pretty much per citizen.
Yeah, exactly.
If you pay taxes, it's $250,000.
That's what. Oh, yeah, that per tax. But and the problem is no one's buying our bonds. The Fed just prints the money. They turn around and they buy the bonds. And I, that's not going to work in the long run. I don't think.
Yeah, I mean, at some point it's gonna be people are gonna lose faith, and
Yeah.
that's
Yeah.
the big thing. So
Yeah.
when that is, I mean, who knows?
I think it can come faster than what we realize, it's like, I think what
Yeah,
we
with
think
higher
we're learning
rates, I
all of a sudden
mean, if they start, the interest keeps going higher and higher, then yeah, I mean, that could spiral real quick.
yeah, yeah. So
Yeah.
I think it's gonna have a profound effect on a lot of these companies. I think the layoffs are still yet to come, so.
Yeah, apply to Dan there too. I also agree that the Fed is stuck between a rock and a hard place, but I think my hard place is a little different. My hard place is the fact that they cannot do anything about supply side of inflation. Companies can just raise prices whenever they want, and the Fed can't do a darn thing about it.
Hmm.
So when the companies are raising prices to higher levels than they should on essential goods and services, that's when it hurts. And that's when we are whining about high prices at the gas pump because there are high prices at the gas pump. The Fed can't really do anything about that, so you can't blame the Fed for that. They just can affect overall demand, and that's and prices, in my opinion, won't come down until overall demand gets satiated, and it's like, well, we can't put up with the high prices anymore. We're just going to stop buying a little bit of everything, which is what an recession is, right? That's when we have a low negative GDPs or way low GDPs, and that's kind of where we're sort of headed. So and we can't. That's the rock and a hard place I see the Fed stuck in, is they can't do anything about companies raising prices. And as investors, when we bid up prices to evaluations that are already high to even higher ones, we're not helping as investors, right? We're just giving companies more reason to raise prices more because we're bidding them up. So so consumers are part of the problem because they're paying whatever they're paying for high prices and are willing to do so. And investors are kind of the problem because we're actually pushing prices higher in the companies that we invest our money in because we want them to raise prices, but not too high. But there's no qualification on what price is too high for anything. So that's what a free economy is. It's a free reign to try until your buyers aren't buying anymore, and then you've raised it too high. So we'll
Right.
have to see. We'll have to see. But I see more friction every day from the different people I talk to, listen to, or read about, or whatever. The divide that we have in our country is just getting wider. And I wanted to say this to Dan and for another reason, but we're all we're all kind of dismissing a potential war with China. And if you've been reading anything about China's economic woes, they're not in really good shape. And if this is something I think we should watch out for a little bit more than we are, is the black swan event of China invading Taiwan.
Mhm.
President Xi is comes under the belief that his economic policies are not working. He's going to get his citizens to focus on something else other than the economy, and why not invade Taiwan? The U.S. is more vulnerable when we're more divided. So the more divided the U.S. is, the less they're going to do about it. I mean, we've probably done as the least we can possibly do to help out the Ukraine without offending one side of the aisle or the other, right? We're doing something, but not probably as much as one side would like, but more than the other side would like. But we're kind of like walking the tightrope. If Taiwan gets invaded, it's a different story, I think, than the Ukraine. So I would be more worried about that popping up as something that has a lot more potential than it's getting news coverage for than we're seeing, in my opinion. So, and next year is our election, right? So we're going to be the most divided as we're ever going to be leading up to that election. So if I was China, I would strike now between now and when the election happens. If it was me, why? What could be better? I don't know. So that's one fear that I worry about, and don't know how to you can't really make a play for something like that until something actually does happen. But there's a big monkey wrench there. I think that China is and we don't hear from them. They don't have a national news outlet that lets us know what the people actually think. So the government can control the people more. Anyway, duck for that. That's my warning. Watch out for that.
Dave, I share your fear on China. I think that they really don't care what their people think. Their ruling regime are going to do what they want to do and do what they need to do. And I don't even know if it may not even be focused on Taiwan. They're disputing a lot of territory in the Pacific, and they feel like they're being provoked every time we have our destroyers go through. We're Canada or European trying to keep those shipping lanes open. They're building all those islands out there, the artificial islands, and they're putting military bases on them and everything. So I agree. I think the chance of going to war with them, and I don't think it would be just them. It'd probably be them, North Korea, Russia. They'll probably all jump on the bandwagon if they're going to go against us. But as they say, war is great for business. And I think if anybody's going to, has a good chance of pulling out, having better economics, that would be China, because they build things, they make things. We just consume, and even a lot of our weaponry, which I think is treasonous when we have critical parts for some of our defense mechanisms being made in China. It should be all homegrown as far as I'm concerned. But it's a scary thought. I know I got some friends that are military strategists, and they all agree that China is the elephant in the room. They're the ones to really be fearful of. It's not Russia. If anything, we should probably be trying to talk peace with Russia. We have more in common with Russia than we do with China, and I think the only reason that Russia and China are allies right now because the enemy of your enemy is your friend, and I don't think there's any real love between China and Russia. So, but anyway, just my 2 cents worth.
Yeah, well, obviously a concern, the Taiwan and then, China and Russia teaming up. I think North Korea is visiting, went to China, anyway, so we'll keep our eye on that.
I don't think Biden going to Vietnam really sent the warm and fuzzy to China either. Yeah.
Yeah. So, okay. Yeah, thanks guys. Let's dive into the earnings here. So I have the results. So, and all of this has been shared in the share drive, and that's in the emails that come out. It's in this folder. So you get the results, and then all the different spreadsheets for each of the strategies are in there for Q3. So, and I pushed out the plan, so everyone should be able to pull this up in the platform. So let's look at the results first. So down here, I've got to change that. Huh? 20. Okay. Q1. Sorry. Okay, so this would totals from Q1. Obviously, that wasn't a good overall result. Not terrible, but this time, obviously, we go through here. We still have quite a few trades that aren't confirmed. So you can see 22 overall. that weren't confirmed. But for the bullish pre-runners, we had 13 trades. Not a great win rate. Still up money. Bearish pre-runners, two of them didn't get confirmed, but with 3 winners. So the vol rise, so that's the only loser. 4 trades, down a couple hundred there. The non-movers were the best, obviously. 5 trades, they all won. Good profit, obviously. Bullish runners, so you can see here, 11 trades, 73, not great. The bullish trades just, they still squeaked out, profits, which is good. And, actually the bearish ones did really well, with the bearish runner 90, the bearish pre-runner 100. So, but overall, you can see here, that's our total. So we had a profit at 8250. That's our losses, 1552, and then the net was 6698. So with about a 75% win rate. So it wasn't like one of those banner quarters where we're like 86% win rate, but it was a solid quarter. So hopefully we get something similar, for Q3. Any questions on the results here? Okay, so all of these are available if you want to look through them. So basically, I took the liquid list and did these scans, and then did this testing for the strategy on all these symbols, and I walk it down from 20 days all the way down to 5 months. The runners I do 20 to 10. Then you have your win over 80, so I just separate those out in case people want to trade more. And then I just narrow it down to best trades, and I pull out anything that's high risk, like this Northrop Grumman would tilt everything with a big risk amount. So I just pull those out and put these in, push them out, and that's what you guys get, the alerts. So all those are available if you want to go through them. If you have questions, just shoot me an email. But the plan's out, so you can go through and sort. You can print it. Looks like our first trade date 9/21. That's estimated. So hopefully a lot of these start becoming confirmed. I think we only had 1, 2, 3, 5 confirmed right now. So so the first confirmed would be this one, ACN. That's a bullish runner, so after earnings. So hopefully a lot more, because ever since COVID, these number of non-confirmed have really popped up, and it hasn't been a big retreat. So they just kind of, it's been an issue. So okay, any questions on the earnings, comments?
Thanks for doing that. It was profitable for me last quarter, so it's great.
Yeah, it'd be nice to, like we always look at the market, but nice to get like a little dip going into the earnings and then kind of rally, through the beginning earnings. And that's how we normally like it. So we'll see. Thanks, Adir. Anyone else?
Josh, I would just offer a couple comments. Like Sadir, great job organizing all of this. A couple numbers, you point out the non-confirmed trades. So we do have a database. I mean, if anybody's interested in non-confirmed trades, and on average it has been this 20 to 25 range, but a high percentage when we only had 46 confirmed trades and 22 get bounced out because they're not confirmed. It's a heck of a percentage. We can go into our database and check to see past earnings, day of week, how many days since the last release. We've got all that behind the scenes. So if you're interested in a non-confirmed trade, we can do some, homework for you if you have questions about that. And then just in terms of your narrowing the pie, we were talking about this yesterday, just having gone back and looked at, whittling the 80% to 90% and the 8%, pricing factor. Basically, in the last couple of quarters, it was just shy of 1,400 different trades, which you whittled down to, just around 70. So as Josh pointed out earlier, there are countless other opportunities. If people are interested in, we'd be happy to talk to you about any of that too. But yeah, great job with this, Josh. It's a heck of a spreadsheet you got going.
Yeah, thanks. So I did want to point out we still have open trades for the bearish runners. I had that pulled up. So there's 4 out there. So it's up 12.55 right now, and we're down a couple, 400 so far. These haven't closed out, but I'll update this as they close out. So not going to be a big effect on the overall total. So
We hit its profit target today in live trading.
Vive?
Yeah, yeah.
All right.
For me today, and hit its profit target.
No, good. I think I was tracking it. Yeah.
Oh, and so did CRM.
All right. Well, I have to wait till the end of the day. So that's good to know, though. So thanks, Sadir. Appreciate all the help and the updates on the actual live trading. So, and we're working on this, the new UI. So we've been sidetracked for a couple weeks, but now we're back. Trying to roll this out. So that's all I had, Joe. You got
all right, Jack.
charts?
Sure. Let me grab a few charts, but interesting conversation earlier for sure. And at the top of my notes list, I have government financing, auto workers strike, and national debt. So good job touching on all that, gang. And to that whole conversation about pricing, I think, the auto workers strike, even though it's only 150,000, it's just, it's that same rock and a hard place where the Fed is. There's just, what is the right price? And I'm seeing it personally still. I mean, a couple things when you go out and shop are down a little bit, but, more often they're either holding or I still see prices going up. And, that whole idea of national debt, Josh and I were talking yesterday, saw an article where I think historically the highest our debt had been as a percentage of GDP was like 6.6% in the 80s. I think that might have been, I'm not sure what time frame in the 80s, but basically we're up to north of 7.8% now, which is, by far the highest we've ever been. And, we're not, well, I guess in a way we are financing a war. It's just sort of not our war. So anyway, yeah, those whole issues of, government financing and national debt are right at the forefront here. And yeah, I'm inclined to think that, we're going to go to the mat with, this government financing, having to expand our spending base. I'm not sure we're going to come to an agreement with that over the next couple of weeks. But along those lines, I went back to 2011. I know it came up, in our conversations back when we were talking about extremes, in state eights and the pie. So here we are, August of 2011. Look at that pie. That's damn near, 8.29% green. And, that's when, we weren't able to fund the debt. So I'm not saying we're going to go there anytime soon, but, and I'm not sure, define it exactly as a black swan event, but it would certainly add a lot of volatility to the marketplace. So I think it's the end of September, isn't it, Josh? This whole government financing.
Yeah, Usually it's
Yeah.
September.
Right, fiscal year, so.
Yeah.
So, yeah, talking about some charts, well, let me go back to, the new UI, and really, this is going back to the 12th, but, the one thing that has changed just last week really was, if we're talking about the ETFs, we added, I guess, 2 new bullish signals, with the ETFs. So, we're up to, I guess, 5 bulls now. Let's see, 6 bear, 5 bulls, 5 are ones, and we added XLF, as Josh mentioned earlier. That went into state 1. So I did go in and pull up that chart. It's not a good state chart. I mean, basically the signals, have not really been very good in terms of state modeling. So, and it's not really that volatile an index, but it did roll into a state 1 just yesterday. I don't think it's really very meaningful. Then, just showing a few charts as Josh always does. Just the point here being we're well off the mid-August to late August lows in the indexes, with the exception of Russell. There's SPX, obviously in the state 1. We've got Russell banging, I think it was 1846. The lows are somewhere between 1827 and 1830, going back a little ways. So, and that's down today. Yeah, I mean, I'm not sure, since we started what the market's been doing, but I was a little surprised. It was down today, not kind of following the rest of these indexes. NDX was up 100 points last time I looked today. Has really, been the leadership of the market. That's not breaking news, as we know. State 1 for 8 days, still got, a long way to go if we're to get to an average move. But I did, there've been a couple earnings come out, NDX being our leader. We've talked about XLK, a fair amount as leadership in time. So I thought I'd kind of get into a couple XLK charts as well. XLK we talked about last week briefly, just the fact that it did, go back into state 1. It's actually gone the wrong way after that state 1 move. But, still, pretty darn strong. The recent low here, basically 163, would be an important level to keep an eye on here, I think. But part of the reason XLK maybe had a bit of a red candle yesterday was, one of the stocks that had recent earnings. And I'm not going to go there just yet. Adobe's earnings come out tomorrow. So I thought I would just pull that up. You had a pretty good sell-off at Adobe yesterday. And then, in terms of XLK, going back to the index, I think there are about 55 underlyings in XLK. It's been incredible leadership for the market. We had a heck of a state 1. It is, in essence, half Apple and Microsoft. Apple is shy of 23%. Microsoft is, just shy of 23% also. You've then got, we've talked about this before, NVIDIA drops down to 5% of the index. Broadcom is 4.3%. And then Adobe, whose earnings are tomorrow night after the close, is 3%. So, those 5 encompass darn near 60% of the index, and you've got, another 50 or so issues that make up the other 45%. But I think that, in looking at these charts, so, I think XLK going to be important to see whether, stays healthy. Going back to Adobe, had a pretty big sell-off yesterday. Not sure why, but it was back up right before the meeting started. I think it had, basically gained all of yesterday's loss. Earnings tomorrow, they are looking for $3.97. They came in with $3.40, same quarter last year. They're looking for an increase in revenues of about 10%, which is just shy of $5 billion for the quarter. So they're looking for $3.97 and then, $4.86 billion, for the quarter. I think something to look for after the close tomorrow. And, part of that is because of this next chart. I don't know how many people were paying attention to Oracle. Oracle is also part of XLK, lower down in terms of the percentages. I think it's about 2%. But, here's Oracle, it's had its, worst day in a long, long time. Yesterday, stock was down about 14%. So, that, and basically their hard numbers were not bad. They actually beat. And the problem with Oracle was, their forward look, which is always the case, especially, when you're talking about expanded price earning multiples. I think, it's going to be important to kind of keep an eye on Oracle and whether it holds yesterday's lows or, continues to give some pricing back. So the other ones I do want to just pull up were, the big one.
Can you keep that one up
Yeah.
for just a second? Just the Oracle chart?
Absolutely, Dave.
Okay, I was just going to say, scroll down just a little bit. There you go.
Yep.
Notice the run up in, what was it, June? That was the AI flap, and look where the stock has come back down to. And I think that was the of all the, because I follow that. I don't own that one, just so everybody knows, but I do follow Oracle quite a bit. And that was the reasoning that most of the analysts downgraded it, because where was the AI contribution to their stock price? Well, it wasn't there, so they all took a hatchet to the multiples kind of thing. So I think that was the reason for Oracle. And now I was going to ask you then to just show Apple. I don't know whether you're going there or not, but Apple's got an interesting story.
How's that, Dave? That was the next chart.
Okay, go. Go ahead and I'll comment later.
No.
Great minds think alike. All right. So you can look at Apple. Apple had a big run up, right? And then it sort of sold off at earnings. Then they bought the dip, and then the price went up after the dip by a minute, dropped back down again, to where, and it's dropping today, because last night was the preview of all their new products, right? This is the Apple press day or whatever, and apparently that didn't come off as all excited. People were not all that much excited. So, I've commented before, and I watch Apple, and Apple seems to correlate fairly highly to both the NASDAQ and the SPX. So there's some headwinds there, and Apple already warned for the next quarter, last quarter. So, the buy the dippers are hardcore, though. So you can't really trade on what you think is going to happen. You got to kind of trade with what you think everybody might be doing over whatever time frames, too. So. But Apple's an interesting thing to watch, and it's I don't know where I try to look at support and resistance, but like I said, it's hard to figure that out when it's kind of like a cultish, like Tesla is. The Tesla people keep that stock higher than the valuations probably warrant, but that's where it is. So go ahead. Now you. Sorry, I didn't mean to step on your toes about that chart, but go ahead. I'm sorry.
Not at all. All good. But, Apple critically important. As you pointed out, yesterday was a big day for Apple. That coupled with the fact that it's such a big part of XLK is part of the reason I wanted to look at it. I was, a little taken back at what I perceived to be, short-term weakness in the stock. I guess I hadn't looked at the chart in a little while. 172 at this point, is going to be the big one, in terms of Apple, as far as, whether it holds or not. It wouldn't shock me. If the market rolls over, what do you got? You got a high of basically 197 down to 171. That's basically 25, 30 points. You know, you got a high 190, 71.65. You know, it wouldn't be a shock if you got a symmetrical A, B, C to the downside if the market rolls over. So, and that's going to be a retracement coming off of these January lows as well. So, you know, it's just going to, there are lots of headwinds. If the market, you know, rolls over and has a bit of a correction, I would think you're going to be talking, you know, 160, 165 in Apple at some point. And the one point I didn't make about Oracle, and this obviously goes for any position, but always the thought of risk management, you know, so, you know, we're doing basically call spreads and put spreads, but, you know, just that's, you know, a heck of a piece of downside. And as these, you know, multiples expand, obviously puts cost money, generally vols are, you know, been relatively low. So just, you know, that whole idea of managing the risk around your portfolio is an important one, and maybe something we can start to talk about a little bit in future calls. Just looking at a couple of the other big charts in XLK is kind of what I wanted to really wrap up with. Here's Microsoft. I think, you know, pretty similar to, you know, what Dave talked about. You had the run up coming out of the whole AI situation in June, July. You know, we're well off the highs. I mean, stock's still, you know, plenty constructive. We're in state one, just been there for 5 days, got a long way to go in terms of average days. You know, more constructive here in Microsoft and some of these other charts. The other big ones, we got NVIDIA, which we've, you know, shown in the past, but, you know, NVIDIA is just, again, pretty constructive, just in a back and fill here. Looks like that, you know, 403 range is, you know, we're a long way from that, but important level to hold at this point. This is Broadcom. This is the one that is, I think, about 4.5% of the XLK, you know, rolling over. Yeah, just basically sideways. Bone fell. You know, fairly constructive, but you know, just kind of in a sideways pattern now. So they're the big ones in XLK, which I think if you know, has been leadership. I think it's going to continue to be such, you know, the same, either the upside or the downside. So well, I pulled up the charts. We talked about the TLT earlier. You know, it has been, you know, in you know, state 8 for a long time, twice as long as normal. But you can see it's still a long way from as long as it's ever been in, you know, a state 8. So you know, we could stay here for a long time. Just some of the other headwinds in the market, you know, energy, we know what's happening there. And we continue to just, you know, move higher. That's a heck of a chart in, you know, the XLE. And then last, I guess we got, I just pulled this up because, you know, emerging markets, just because, you know, the Russell's been lagging so much. I really hadn't thought about emerging markets versus the Russell, but it's had maybe less volatility, but a little bit similar. Reminds me of the Russell maybe year and a half ago when we went sideways for, you know, probably 15 months. That's all we got in the EM. So plenty of headwinds, which is always the case, but I think those bigger macro pictures that everybody was talking about, government financing, national debt, you know, and then, you know, God forbid that black swan with China. I mean, you know, they're out there, and let's just hope that no, China doesn't, you know, doesn't go nuts on us. So, any comments or questions? Happy to talk about anything. If not, Josh, back to you.
All right, thanks, Joe. Anyone else before we wrap it up here? All right, well, thank you all for tuning in, a good conversation, and we'll do it again next week. Thank you.
Thank you.
Thanks, guys.